What we're also seeing in the bond market is in the 2-year and 5-year range, the so-called belly of the curve, we're seeing those interest rates move up as well. Now, they had been held down for the most part because the Fed was saying, we're not going anywhere. We're not going anywhere. But now they're not being held down. And this could be the beginning of the market leading the Fed. Historically, that has been the case. The market has led the Fed. And what this could mean is the economy is so strong that the markets are now saying, okay, we don't need this quantitative easing. And the Fed is going to come to the same conclusion pretty quickly. So let's anticipate that move. So here we are. We think that move is on the way. Now, this also reminds me of the late 2016, early 2017. And at that time, the quantitative easing was on its way out, and the Fed was going to start raising interest rates. They had telegraphed that, and the market was very nervous. And I remember one of the reasons it was very nervous was after President Trump won the election, the odds of a cyclical burst increased because of his promise to cut taxes. And that's exactly what happened. But in the beginning, the equity market responded, was very nervous around this idea that interest rates would be going up. And what happened is when President Trump was elected, value stocks took off. Just like they're taking off now, responding to this idea that this economy is developing ahead of steam. So the value stocks have taken off. And in fact, if you look at year to date, I think financial stocks are up 27%, and energy stocks are up 27%. Financial stocks are up about 11%. I think technology stocks, if I'm not mistaken, are up basically 1%, and healthcare, which is another area in which innovation strategies, or to which innovation strategies are exposed, that's actually down. So traditional value stocks are having a nice run here. And how do we feel about that? We feel really good about that. Just like we did in 2016, when we said value is up, and actually the market was up, value up even more, and growth strategies like ours were down. They were actually in negative territory back then. And I remember saying at the time, I think this is great. I think it's great because the bull market is broadening out to other sectors. And that can only be a good thing for us. What would be very negative for innovation-based strategies is if the market continued to narrow so that only innovation strategies worked, because that's what happened during the tech and telecom bubble, and we all know how that ended. There was too much capital chasing too few opportunities back then, too soon. The costs of the new technologies and the technologies themselves, the costs were too high and the technologies themselves were not ready. But the seeds for innovation, the innovation platforms that are moving into exponential growth trajectories right now, they were all planted back then. So I actually like the fear that we have experienced. I like it, and mostly because I don't think it'll last. But I'm happy that there's a reality check in terms of the speculative moves that have taken place within the innovation space. Now, what happened after the fourth quarter of 16, after the market had broadened out, was 2017 was a fantastic year for the equity market generally, both cyclical value and growth. And I would submit and consider the source. It's what we do all day long. I believe we're moving into the same kind of environment.